Hi, welcome back. In this session, I'd like to talk about optimal debt ratios. If you look back at the sessions when we talked about optimal debt ratios using the cost to capital approach, you probably already recognize that the key driver of what the optimal debt ratio for your company is how much the company generates as operating income. Why? Here's why. If your operating income is low or negative, you're going to be unable to borrow money, and here are the reasons. First, you don't get the tax benefits from debt that you thought you would, because for interest expenses to save you taxes, you need taxable income. If you're a money-losing company, let's not even talk about the tax benefits of debt. Two, as you borrow money, your interest coverage ratio is going to drop much more dramatically if you have low operating income than if you have high operating income. Why does that matter? It affects your rating as a company, your default spread, and your cost of debt will climb much more quickly. And finally, if you think about what happens to your beta as you borrow more money, the effect of borrowing on beta increases as your tax rate decreases, as you get less tax benefits because you don't even get the partial shelter you do when interest is tax deductible. So if you have a company with low operating income relative to its value as a company, so when we talk about low or high, it's always got to be scaled to the size of the company in terms of market cap. It'll have a low optimal debt ratio. Now, some of you might be wondering why I'm focusing on operating income rather than EBITDA. After all, people talk about EBITDA as cash flow. If you're a healthy company, a growing company, the DA in your EBITDA cannot be used to service debt. In fact, if you're using your depreciation to service debt, you have to either be a shrinking company or an unhealthy company, and here's why. You got to put that DA back, the depreciation and amortization, back into the company as capital expenditures to allow it to maintain its earnings power. So operating income becomes the key variable that drives the optimal debt ratio. Now comes the catch. When I ask you to compute the optimal debt ratio for your company, open up last year's financials. Why? Because it's the most current numbers. Use last year's operating income to come up with the optimal debt ratio for a company. You might say, so what? Well, for many companies, last year's operating income might not be a good indicator of how much you should be borrowing, and here are some of the reasons. If you have a cyclical company or a commodity company, last year can be a very good year or a very bad year because of macro reasons. If you're a cyclical company, last year could be a boom year and your earnings could be really high, or last year could be a recession year, in which case your earnings can be really low or even negative. If you're a commodity company, last year's earnings can be really high if commodity prices were high, or really low if commodity prices were low. You can also have companies that have really good or really bad unusual years. For some reason that year something happened that made your earnings higher or lower than expected. And finally, you have companies that play earnings games where they move what should be operating expenses below the column and they make their operating income look higher. For these companies, focusing on last year's operating income can give you a misleading view on how much the company can borrow. You're saying, what do I do next? Well, if you have a cyclical company, you need to think about how much you can borrow with a normalized income. You're saying, what's normalized income? Think about the economic cycle. In good years, you make lots of money. In bad years, you don't make very much money. You can lose money. What you're looking at is, what do you make across the cycle? Because you should be borrowing based on normalized income, not on abnormally high income, in which case you'll be borrowing too much, or on a recession year income, in which case you'll never borrow money. So when you borrow money, you should be borrowing based on normalized income. Now the question is, how do you estimate that normalized income? The standard practice that many analysts use is to look at the average income across a cycle. So if a cycle comprises 10, 11 or 12 years, you take the income across those 10, 11 or 12 years and you average the income. Well, that might work if your company is not scaling. In other words, if it's not getting bigger or smaller. But if your company is getting bigger or smaller, looking at the average dollar income across 12 years is not going to give you a normal income, right? I'll give you what I find to be more useful for companies. And this applies across all companies, but particularly for companies that are either scaling up or scaling down. Look at the average operating margin across a cycle. So an automobile company might make 15% in a good economic year and minus 3% in a bad economic year. Look at the average margin you make across the cycle. Make it a pre-tax margin. Then take the revenues you had in the most recent year, and revenues are not as sensitive to the cycle as income is, and apply the margin to those revenues. So let's say last year you made $2 billion in revenues. You're a cyclical company, actually lost money last year. But in a typical year, a normal year, you make a 5% margin. 5% of $2 billion is $100 million. Make that your base operating income to come up with what you can afford to borrow as a company. So let's try this on a couple of companies. The first company I'm going to use is Turkish Air. Turkish Air obviously is an airline, and like all airlines, its earnings go up and down, and superimposed on top of this is an ambitious airline. Ambitious in what sense? It wants to grow. You can see that in the numbers I report as you go through the different periods, is you go from an earlier period where revenue growth was low and margins were high to the most recent periods where revenue growth is high and margins are low. So here's what you face when you sit down to compute the optimal debt ratio for a company. If you believe that the company is going to continue to be ambitious and cut prices and settle for lower margins, its optimal debt ratio is close to 0% because it's not making very much money. It's focusing on growth, and that's okay. You can focus on growth, but you can't have your cake and eat it too. If you believe that they're done with that big growth phase, that they're going to revert back to an operating margin they had between 2012 and 2016, which is not a great margin, but a better margin than today, then their optimal debt ratio is 10%. If you believe that they're going to revert back, now that the growth is done, to the margins they had of 8% plus pre-2011, then they can afford to have debt ratios of 30% if they go back to the 2007 through 2011 numbers, or even 40% if they go. You're saying, which is the right number? You have to have a story for a company to come up with the optimal debt ratio. I don't know what your story for Turkish Air is, but whatever that story is will drive what kind of optimal debt ratio you will see the company having. Here's the second example, Henkel. Henkel is a German company. It's a very boring German company. It doesn't grow very much. It's got healthy margins, so it's a profitable, boring company. Its margins actually last year were much higher than they've been historically. It's tough to tell why that happened. The margins are 16.11%, but here again you have a choice. If you believe that they're now in steady state, that they're now going to go for no growth and maintain their 16% margins, they can afford to have a 40% debt ratio. If you believe that over time the margins will revert back to what they used to be in the previous 10 years, your optimal debt ratio is 30%. Here again, what you devise for the company will have to be consistent with what else you see for the company coming through in terms of investments and dividend policy. So if you believe Henkel is going to go back for growth and settle for lower margins, you need to settle for a lower optimal debt ratio. One final example, a company called Cussons, Nigeria. It's a consumer product company, obviously in Nigeria, and it's been hurt really badly since 2009 because of two problems. One is country risk. Nigeria has had a lot more country risk, and the currency has collapsed. A devaluation of the currency has essentially decimated the company. Why? Because it imports its goods from outside Nigeria and it sells them in Nigeria, and because exchange rates have moved against it, its margins have essentially shrunk towards zero. If you look at where they are in 2016, their optimal debt ratio is 0%. They have too much currency risk and country risk to add debt on top of what they already what they already have. If they can improve their margins, if you say, look, the bad times are now behind us, Nigeria is going to be on a pathway to recovery, you will be much more optimistic about how much Cussons Nigeria can borrow. If they can revert back to the margins they had between 2009 and 2016, which are not great, but better than they are today, their optimal debt ratio goes to 20%. If they can go back to the way things used to be before 2009, and I'm not sure whether this is even feasible, their optimal debt ratio climbs to 40%. Notice how your judgment of how much the company can borrow now rests on what you think about the country. That's a fact of life with emerging market companies. Their capacity to borrow money can magically expand or shrink to things out of their control, primarily because of country risk and currency risk, factors that they don't control. With commodity companies, the analysis gets a lot trickier because normalizing is what many analysts do, but when you normalize oil prices or coal, you're making an implicit assumption that things are going to revert back. But commodity price cycles are really long-term and really unpredictable. You might be a good forecaster of oil prices, but I'm a terrible forecaster of oil prices. If you made me the CFO of an oil company, and please don't, I don't want to be that, then I have to compute the operating income you will have at what I think is a normal oil price. And God help me on that one. And that operating income will be higher if my oil price is higher. Let's take an example. Let's take Royal Dutch, a company where oil prices drive revenues and operating income. So here you have a graph of how much the operating income is affected by oil prices. And I'm going to say the obvious. When oil prices go up, operating income goes up. When oil prices go down, operating income goes down. I was looking at the optimal debt ratio for Royal Dutch in 2016 when oil prices had hit $40 a barrel. At $40 a barrel, the optimal debt ratio for Royal Dutch was 20%. If oil prices go to $30 a barrel, that goes to 10%. If they go to $80 a barrel, the optimal climbs to 50%. Again, the way you will set the optimal debt ratio for an oil company will depend on your perspective on oil prices. Given my perspective, which is I cannot forecast oil prices, I'm going to try to optimize at the existing debt ratio. But I'm also going to be cautious about the fact that if oil prices drop, I'm going to be exposed. And if you look at the most prudent oil companies in the world, the ones that are still standing, they are companies that recognize that oil prices move through very long cycles. And to be lulled into borrowing just because oil prices stayed at $80 for 5 years can be an extremely dangerous action to take. And finally, let's talk about companies playing operating income games. Over the last 20 years, companies have become very good at moving expenses, which are operating expenses, below the line, making their operating income look good and creating these extraordinary charges. If you have a truly one-time item, either pushing income up or pushing income down, life is easy. Just take the one-time item out. As an example, every 5 or 6 years, Boeing has one quarter where they have a strike which costs them $1 billion. In the year in which they have the strike, their operating income is much lower. But you know this happens only once every 5 or 6 years. So when you decide how much to borrow, you will factor that in. You won't take the last year's number. If it's pushed down by $1 billion, you'll spread the $1 billion out over 5 years. If you have a company that consistently plays games, then you have to almost redo the financials and figure out what the true operating income for a company is. And there you have to delve into the accounting details. And I don't envy you, but it has to be done with companies playing operating income games. So the bottom line is, when you try to compute the optimal debt ratio of your company, you're not computing the optimal debt ratio given last year's operating income. You're computing the optimal debt ratio for operating income for the future, so you have to be prudent, because it's much more expensive to overreach and then have to come back than it is to underreach and adjust gradually. There will be judgment calls you got to make along the way, but that's okay. We all have to make judgment calls. I hope you found this useful, and I look forward to talking to you again. Thank you very much for listening.